Matt, great to catch up with you, sir. Just build on that a little bit more, what you're looking for in the next couple of months.
Thanks, John. Well, so obviously the election is an event on investors' minds. And so we did some work to try to understand when we might actually know the results from the November 3rd election. And it seems to us, based on the surveys that we've done, that a base case of knowing who the victor will be on November 3rd seems a bit optimistic. So we're expecting to know the result, certainly in the week of the election, but perhaps not on election night or early the following morning. And historically, when you have a situation like this, doesn't occur very often, if only one time in recent memory, risk markets responded poorly. Of course, you go back to what happened in November of 2000, and you see very clearly that in the wake of the uncertainty surrounding that election, investors expressed that by reducing risk exposure in equity markets, clearly caused a bit of a flight to quality into the Treasury market. And so, that's something that we're looking at right now, John.
Well, Matt, let's build on that. The flight to quality and whether treasuries are still a part of that story. And in the words of Mohammed Al-Arian, offer you those risk mitigating characteristics that you might want in a risk drawdown. On the screen right now, 10 minutes away from the opening bell, equity futures on the Nasdaq negative 3.2%. And we do have a bid into the bond market. Treasury yields are down around about 4 basis points on 10s, down 6 basis points on 30s. Matt, as far as you're concerned, looking at treasuries right now, will they continue to offer what they have typically always offered when risk assets do poorly?
I believe so, John. I think we saw this very clearly back in March, not necessarily in the Treasury market, although, of course, Treasuries did very well. The starting point was from a much higher yield level than we have today, which is, I think, to your point. But when we looked at, let's say, the German Bund market back in March, German Bund yields started out extremely low and went even lower. In fact, the 30-year German Buxel traded down to its overnight financing rate. In other words, people were not only willing to accept a negative yield at that time, but they were willing to accept a negative yield below its overnight financing rate, which meant that there would be no carry for a levered investor into that paper. So, the corollary in the Treasury market would be akin to the 30-year Treasury going from 1.4%, which is where it is today, down to about 12 basis points. So that 100 basis point decline in the 30-year Treasury yield would offer you a total return in the context of 17, 18%. That will go some ways to mitigating any type of bear market in equities at this point. So I do think that longer duration treasuries will still offer you that protection.